Good evening, everyone. So we are here to discuss the MCQ part of financial reporting paper, which got concluded today. Right. If I look at the MCQ at the first look, paper looks slightly lengthy, but difficulty level I would say is average. It's not very difficult. Of course, additional time would be required to understand and solve some of the questions, but still I think if you had a good conceptual clarity, you would be able to crack these case-based as well as direct MCQs. So we'll quickly have a review. I'll not give a detailed solution, but I'll give you a way in which you can reach to the solution. Some of them I'll solve it directly, and later on we'll come with a detailed solution so that after the exams, if you want, you can review the answers. So the first case scenario is about a company which manufactures ship and vessel parts. So they're given about a company, and the accountant needs the guidance in closing the books. So issues are given. On 1st May, they acquired 75% equity of Seahawk and gained control of Seahawk on 1st of May of 22. Seahawk has 90 lakhs equity shares in issue. Details of purchase considerations are as follows. So purchase consideration details are given. Issue 2 shares for every 3 shares acquired in Seahawk. On 1st of May, market value of an equity share in Sealink was 7 and market value of an equity share in Seahawk is 6.25. So basically for us relevant is 2 shares for every 3 shares. This on 30th April, C Limited shall make a cash payment of 75.6 lakhs to the former shareholders of Seahawk Limited who sold their shares to Sealink on 1st of May. They would have needed to pay an interest of 8%. So basically what is this? This is a deferred consideration. You have to discount it and bring it back to a present value discounted by 8%. Then Sealink may make a cash payment of 250 lakhs to the former shareholders of Seahawk who sold their shares on 1st of May. It is contingent upon revenues growing by 14%. So it is a contingent consideration over a 2-year period from April 22 to May 22 to April 24, right? Fair value of the contingent consideration was 230 on 1st of May and 31st March fair value is 240. Now which one will we take? We will take the one which is on the date of the transaction, that is 1st of May. Fair value of 230 will be considered. The change in fair value, this will be recognized in P&L, right? So this we have discussed enough times in the class as well. Okay, so that is with respect to the acquisition. Sealink sold some ship and vessel components to a customer on 31st December. Invoiced amount was 8 lakhs. They expected to receive the payment on 20th of February of 23, but no cash was received till 31st of March. On April 30th, the credit control department informed that the customer has major cash flow problem because of failure of its projects sometimes in January. They have agreed to allow customers to settle the debt till 31st March, by which time the customer is confident that the cash flow problem will be resolved. So we have to see whether we have to provide for any expected credit loss, is there any impairment and related aspects. Though Sealink currently expects an annual interest of 6%, effective interest can be received against any money lent out, yet it allowed the customer an interest-free payment period. So payment period is interest-free, and this is what this has been extended to by more than 1 year, and hence we will have to consider the discounted factor. Sealink acquired 25% of share capital of Boat Limited, so this becomes an associate. On 1st of April for 1,40,000, carrying value of net asset was 4 lakh, fair value was 5 lakhs. Okay. Boat Limited became an associate of Sealink, provided the following information related to Boat Limited. Net income, decrease in account receivable, depreciation, increase in inventory. So if you see these terms, these you can directly relate it to the cash flow questions. It holds a financial asset that is actively traded in 2 different markets. Company transactions both market equally. Price of the asset in A is 60 lakhs. If the company sells in market A, transaction cost is 4 lakh. In market B, 58 minus 1. So you will go to the market where you get a higher realization. Sealink also deals and sells satellite communication software license, installation, etc. So all these are done. This is the breakup of what we normally charge from the customer. The customer wanted to place a composite contract for all activities, but did not agree to pay installation service charges. After negotiation, they agreed to waive installation service charges in full, and they enter into a contract with the customer to provide everything at 350 lakhs. So basically, transaction price is 350. We'll allocate in this particular ratio. In this 115. For all 4 performance, you are required to assist Mr. Lalit on account of above transaction on 31st March 23 by analyzing the transaction mentioned above and choose the correct option. So basically, for all of these issues, respective questions we have to see. First, calculate associates Boat Limited cash flow from operation. This you should give 2 out of 2. There is nothing to nothing to complicate the answer. Companies associate Boat Limited's cash flow. Okay, so what is Boat Limited's cash flow? If you come back here, 200 Decrease in account receivable. If account receivable decreases, you add it. Depreciation you will add back. Increase in inventory you will reduce. Tax charge, this will be part of your tax charge itself. Profit from sale of land, 5, right? Now they have not given what is the taxes paid, so we can say this itself is the tax paid. 200 plus 40, 240 plus 25, 265 minus 20, 265, 245, 245 minus 5, 240. So we have the option 240, which is the correct answer, right? Cash flow from operation. Then what is the amount of purchase consideration of acquisition of Seahawk Limited by C-Link? So here you have to take equity. The ratio has been given 2:3. Then you have the present value of deferred consideration. And then you have the fair value of contingent consideration. If you take all of three and total it, you can get to the answer. I'm not giving a detailed solution now. I'll prepare the solution and that will be providing it to you separately. How shall goodwill and investment in Boat Limited be recorded on the date of acquisition by C-Link in the books of the company? So goodwill in which? Boat Limited. This is our associate, right? These are associate. Sorry. Camera fell off. Okay, associate. How will we account? So first thing is we will not recognize goodwill. We will not recognize goodwill, and because we will not recognize goodwill, the first two options are out. Third option, goodwill will be shown separately. No, goodwill will not be shown separately and will be recorded as a part of carrying amount of 1,40,000. Okay, so you can calculate the carrying amount. Similar question you would have seen in one of the elective papers MCQ as well, right? What amount shall be allocated as transaction price of installation service as per provisions of the relevant Ind AS? So here what you have to do, you have 350, right? So 350 multiplied by installation, 50 out of 400. So 0 0 is gone. 5 8s are 40, 8 4s are 32, 3 0. So 8 3s are 24, 6 8 7 43.7 something. 43.75 lakhs, right? So you can directly calculate without wasting much of time. Now, if you look at this, so far we have spent about 8 minutes, and in 8 minutes we could cover 4 questions. Of course, I'm going slightly faster, but even if you go at a normal speed for 8 marks question, by now you would have been able to solve it. Then C-Link Limited holds a financial asset that is actively traded in 2 different markets. Company transactions both market equally. Selling price of financial asset and cost to be incurred are different in both the markets. You are required to determine the fair value. So you will take the one which is more favorable to you. Okay, and accordingly you will have the answer. Which Ind AS are applicable for accounting treatment for the year ended 31st March in transaction of shipped vessels components delivery to a customer as on December 22? So is there something to do with? I think I've vessel components is this one. So what is applicable? Now there, one thing that is applicable is your Ind AS 109, because they're saying which Ind AS are applicable for accounting treatment for the year ended 31st March in transaction of shipped vessels component delivery to a customer. So one is your Ind AS 109 because it is a financial asset, right? That is one. Then Ind AS 10 because there is a subsequent event. So I think option D is the correct answer here. Right, so this is about that, and Ind AS 109 is about your what do you call? Ind AS 109 is for your financial asset, customer being a financial asset, right? So that is the first 6 questions. Then, which of the following common characteristics of derivative financial instrument distinguishes them from other financial instrument? Now here they have asked about a derivative financial instrument, which distinguishes them from other types of financial instrument. Okay, so here basically they are asking us what is the characteristic of derivative financial instrument distinguished from other types of financial instrument. First, they impose a contractual obligation by one entity to deliver cash to another entity to convey a contractual right. So this is not very clear. They are financial investment in stock, bonds and other securities that are marketable. No. So derivative financial instruments are not investment. They have a notional amount or payment provision that is based on the changes in one or more underlying variables. So this is the one which is nearer one. Most financial instruments are valued at balance sheet at fair value. Derivatives are valued at balance sheet at cost. This is also incorrect. So option C is the correct answer. While applying conceptual framework, chartered accountants shall exercise professional judgment, remain alert for new information and to changes in facts and circumstances, use the reasonable and informed third party test, right? So this you would have learned in audit as well, right? So will you use this? Yes. You will remain alert? Yes. You will exercise professional judgment? Yes. So option D. The fancy store inventory records at 31st March reveal the following. Inventory at hand 31st March 3 lakhs. Inventory purchased free on board shipping point shipped by the vendor on March 25th, expected delivery April 1st. So it is free on board. So shipping point itself, we will get the risk and reward. So this is our inventory. Inventory shipped to customer March 20th, free on board, destination, expected delivery date April 2nd. On this, risk and rewards are not transferred. So this will also be our inventory. Good held on consignment by fancy store not included in inventory at hand. So our fancy store, we hold goods on consignment. This we will anyways not include because this is not our inventory. So 3 plus 4, 4.5 lakh. What is the value of inventory? 4.5 lakhs. Then case scenario number 2. Financial statements of Brown Limited for the year ended 31st March are being prepared and the accountant has requested you to share your views on the following issues. Brown Limited is engaged in agricultural plantation and farming on a large scale. The company received a government grant of 10 lakhs subject to a condition that it will continue in engagement in plantation of tree for a forthcoming period of 4 years. They are not considered as bearer plant. The management has reasonable assurance that entity will comply with the condition of engaging in plantation of the tree for a specified period of 4 years. Brown Limited started construction of a godown on 1st of October, taken a loan of $10,000 on 1st of April, specifically for the construction of the godown at an interest of 5%, tenure of 1 year. Exchange rate on 1st April was 75, exchange rate on 31st March is 80. The same amount could have been borrowed by Brown Limited on April 23 in local currency at an interest rate of 10%. So basically the thing is, local you borrow at 10%, foreign currency you are borrowing at 5%. But there is an exchange rate change from 75 to 80. So whatever savings are offset by exchange differences. So in this case, 75 to 80 is 50,000 of exchange difference. 10,000 multiplied by this. So to this extent, we will consider the exchange difference also as a part of borrowing cost to the extent it saves our interest. The same rupee, no other loan has been taken by the company for the construction of godown, and construction of godown was completed on 31st of March. Okay. So loan was taken on 1st of April. So interest, if you see, $10,000 into 5%, this is equal to your $500. Okay. And this will be paid on at the rate of 80. So this is one aspect. Then if you borrow locally, $10,000 into 75, you get 75, 1, 2, 1, 2, 3. Local interest rate would have been 75,000, right? So 75,000. So whatever savings have been there to that exchange, the exchange fluctuation will be treated as borrowing cost. So here you have 40,000 of interest, 75,000 if you borrow in local currency. So the difference will be your, the difference, that is 35,000 out of 50,000, 35,000 will be treated as borrowing cost. Brown Limited purchased an office building on 1st of April and recorded in the books at a value of 5 lakhs under cost model based on Ind AS 16 PPE. Building is being depreciated over a period of 20 years. Brown Limited no longer needs the office building, and on 1st of April it entered into a loan agreement to lease the building to another company for 20 years. Valuation of building was not changed and it stands at 425 in the books after depreciation. Fair market value is 6 lakhs. So this is also a similar question you can see in paper number 6 case study digest of IBS. Brown Limited acquired 10% additional shares in an existing subsidiary company, Black Limited, at closing of 23-24. At the close of 31st March, Brown Limited held 60% in Black Limited. Following relevant information is available in respect of change in non-controlling interest in the subsidiary on the basis of financial statement. Investment in subsidiary at cost, purchase price for additional 10% paid 30,000, NCI 40% is 84,000, other equity 2 lakhs. They opened a new office in Gangtok under a lease. Specific requirement of the lease is that asset is returned in good condition. Director agreed for the same at a cost of 1.3 crores based on current price levels. The lease agreement was signed on 31st March and will last for 5 years. Due to cold weather, Brown Limited will have to spend 45 lakhs at the end of next year in renovating the building. The director's opinion that this expenditure will reduce by an equivalent amount against the overall refurbishment cost payable at the end of the lease term. Relevant discount rate applicable is 10%. Okay, so here 45 lakhs will be spent for renovation. The expenditure will reduce by an equivalent amount against the overall refurbishment cost payable at the end of the lease term. So whatever you are expected 1.3 that you will pay at the end of the lease term, that is being reduced. First, what is the amount of revaluation surplus that will be recognized by the company in respect of building used as office now given under lease? If once you give under lease, it comes under the purview of Ind AS 40, and then fair value model is not applicable, revaluation model is not applicable, so you'll carry it at cost. So option is D. How much provision should be recognized on 31st March for the office held on lease in Gangtok? So 31st March of 24, it was this. So basically 1.3 you'll have to discount it by a period of 5 years, whatever is this payable. Then they have not given lease payment, so basically this thing will be discounted back and brought to the present value, and you can calculate the amount with the appropriate discount rate. What amount should be capitalized as borrowing cost of godown as per Ind AS 23? One is the interest that you have paid 40,000 and 35,000 of savings, so 75,000 will be charged. What amount, if any, would be considered as exchange difference to be accounted for against the loan taken? So exchange difference was 50,000, 35,000 is capitalized, 15,000 is this. So see, these two questions are pretty much cakewalk for you. Okay. Then, at what value non-controlling interest and other equity will be shown in the consolidated financial statement immediately after the change in non-controlling interest? So you can calculate. We have seen when we acquire additional stake, right? When additional stake is acquired, it is basically a transaction with non-controlling interest. You will reduce the non-controlling interest, and you will also, the other equity component, whatever is there, that also will be, changed based on the reduction in non-controlling interest, and you will show that in the balance sheet. What is the correct accounting treatment for the company for the government grant and is in accordance with applicable Ind AS? Now please understand, here we have two Ind AS applicable, Ind AS 20 and Ind AS 41, right? Now whether we should apply Ind AS 20 or Ind AS 41 depends. If you follow fair value less cost to sell model for valuing your the assets related to agriculture, then you will apply Ind AS 41, otherwise you will apply 20. If it is cost model, you will apply Ind AS 20. Now here they have said these are not bearer plants, and hence we'll have to apply Ind AS 41. Okay, so first is recognize proportionate amount of grant 2.5 lakhs in the statement of P&L as per Ind AS 20. I don't think so. Again, Ind AS 20, no. Basically, it has to be Ind AS 41. Now, what have they said? So there is a requirement for 4 years. So over a period of 4 years, you will recognize. So 2.5 lakhs over a period of 4 years as per Ind AS 41. So under Ind AS 41, 2.45 lakhs, 8 lakhs. So if you see, it looks lengthy. And how much time did we spend? I know, of course, I didn't solve everything, but the entire discussion got over in 20 minutes. If you spend another 20 minutes or 25 minutes, you could have solved this easily. And out of 30 marks, if you were reasonably well prepared, if you had good conceptual clarity, you would have easily made 20 to 22 marks without fail. This is, I can guarantee, you can, if you have done the studies well, this was very much possible. Thanks a lot for joining in, and we'll come up with the, the review of the main paper in some time, and in few days time, we'll also come up with a detailed comprehensive solution.